Hey guys, this is AI Mike Zlotnik, not the real Big Mike. Thanks for watching. I love sharing what I've learned about real estate investing over the years, and I'd like to keep you in the loop. Subscribe to the channel for more of my take, and if you want to see the deals we're working on, head over to tempofunding.com.
Hey folks, this is Mike Zlotnik, Big Mike, and today's discussion is all about, are we heading towards an AI investment bubble? The US stock market continues to soar on the back of the artificial intelligence boom, AI boom. And billionaire investor Ray Dalio has sounded a cautionary tale reminiscent of the late 1990s dot-com era. According to his words, this looks like 1998 or 1999, right before the dot-com bubble burst. So recently, Ray Dalio told David Feinberg of the All In podcast, referencing his concerns about the fact that investors are chasing the AI hype with little regard to valuations or microeconomics fundamentals, much like speculators did with the internet stock.com stocks in the late 1990s. The parallels are just difficult to ignore. Similarities between AI-driven equity boom in 2025 and previous few years and dot-com craze are hard to ignore. Number one, valuations are sky high. Many companies, PEs approaching stratosphere, and there are this vast amount of capital pouring into unproven companies and ventures with no clear revenue model and just euphoria related to the AI revolution. And the market logic has shifted. Investors are focusing on future potential rather than present earnings, reminiscent of the dot-com era in infatuation with the user growth over profitability. So risks continue to increase. Now, Ray Dalio pointed out that there is a race to the AI supremacy. It's a battle between the United States and China, unlike anything else that we've seen in the past. It's a war that no country can lose because it's more important than profits, he said, emphasizing the strategic urgency. But the markets are highly concentrated and investors are taking leverage bets, all in similar direction. So the risks have increased while the investors are completely complacent and in this euphoric state of mind. So can we see a significant slowdown? Well, we could. And there's been talk about recession. It hasn't happened. AI investments and that boom has continued to keep us away from a recession, even though the interest rates have been there higher for longer. But we've seen higher for longer interest rates impact some other sectors, but not the overall economy. However, Ray Dalio also warns, if you believe that no recession is coming, you're likely wrong. Recessions do come. It's a cyclical thing that happens in the world. Sooner or later, we will see actually a recession again. And when it happens, the stock markets can significantly correct. Also, through Ray's work, he's described big and small market cycles. And the typical reaction to the type of developments, typically the Fed cutting interest rates. And this expectation of the Fed restarting the rate cuts in the fall of this year, 2025, the significant pressure from the President Trump administration on the Fed chair to restart these cuts, it feels like U.S. economy can't sustain its momentum without these cuts. We might see significant economic slowdown without these cuts. The interest rates at this elevated level have been too restrictive for too long. So the risks in AI stocks in the Magnificent Seven have increased, while a contrarian play in commercial real estate exists. That is a phenomenal opportunity because those markets have already gone through a cyclical correction. So unlike frothy tech companies, commercial real estate values are grounded in tangible assets and they've been significantly depressed. And then they have great valuations today and strong long-term cash flow, making it a compelling alternative for investors wary of speculative bubbles. With rates eventually set to decline, carry market risk-reward proposition could shift dramatically in favor of prudent, value-driven buyers. And given the sensitivity of leveraged investments like commercial real estate to the level of interest rates, as interest rates come down, typically valuations meaningfully respond to that. So pay attention to valuations. In conclusion, great company that gets expensive is much worse than a bad company that is really focused on pricing discipline, especially in hyped sectors like AI. Diversify away from the herd behavior. Market concentration and leverage can quickly become dangerous in a correction. Consider contrarian strategies, such as depressed industries in commercial real estate that provide attractive risk-adjusted returns as the cycle turns and rate begin to fall. History echoes itself. The AI revolution is real, but euphoria must be balanced with realism. Only a select few will weather the cycle, and many may go away the same way they did in the dot-com. So consider risks, options, and invest with prudent and wise thinking. Appreciate your time and attention. Until the next time, thank you.